Good, thank you very much. It's tempting to start today with a corny joke about trying to make bonds interesting, but that's quite a hard task, so I'm going to do my best. I'm going to talk you through how we do it at JM Fin. So basically, getting bonds right is all about getting the macro right. And here is, this is the macroeconomic environment. Here's a brief description of it on the screen. So you start off, can't really see that. Okay, so you start off at the bottom in a recession, GDP grows, and you sort of tip into another recession, which is what we've got with the pink on the far right. Let's throw in a bit of inflation. Inflation is a lagging indicator. As you come out of a recession, people suddenly realise that growth is picking up, and they start putting their prices up. And likewise, people wake up one morning, see that economic growth is slowing down, and start dropping their prices. So inflation is a bit of a lagging indicator. Throw in short-term interest rates to add a bit of complexity. Now, short-term interest rates, base rates, Fed funds rates, those are driven by decisions at central banks. What they do is they have monthly meetings, and when they see that inflation is running away, that's when they react. So they tend to lag inflation. And as you go into a recession, they suddenly sort of realise that the growth is peeling off, inflation is peeling off, and they start dropping short-term interest rates. Now, long-term interest rates are a bit more different, and because they tend to anticipate what's going on. Now, long-term rates, call it 10-year bonds, these are traded by investors. So the decision as to sort of, all their behaviour is not driven by central banks. Now, as you come out of a recession, investors will start to anticipate the turn in growth and the growth out of a recession, and they'll price long-term bonds so that the long-term interest rate is above the short-term interest rate. What they're already saying is we expect short-term interest rates to go up. And likewise, at the top of the cycle, investors will start to see a recession looming on the horizon, and we will start to see long-term rates start dropping off. And that's really investors saying, short-term rates have got to come down, so we're pricing forward to reflect that. What's interesting, and let me just have a look. Yeah, it's okay. It's not going to work on the screen. So this point. Let's try again. Okay. Yeah. So this point here. I'm sorry for the online people can't see it. So this point here is quite interesting because this is where long-term rates and short-term interest rates are the same, and you get the same situation up here. You might have heard people talk about the yields curve, and I'm just going to run through this. The yields curve is illustrated here. We've got sort of duration, i.e. the length of the maturity of the bond, on this axis and interest rate here. And a normal interest rate curve is when long-term bonds yield more than short-term bonds. As we go through this inflection point, when short-term interest rates start getting below long-term interest rates, this yield curve goes flat, and then it inverts, which is the chart on the far right. That's when long-term interest rates are less than short-term interest rates, and then it flattens again. So the yield curves goes through this cycle. It's kind of flat as you start coming out of recession. It steepens into a normal curve, and it goes flat again, and it goes inverted, and it goes flat. And it's a very good indicator to watch in terms of where we are in the cycle. Now, theory has it, this is kind of textbook theory, but at the bottom, you should be looking for falling interest rates, the yield curve starting to steepen, consumer expectations reviving, and industrial production bottoming. As you move into the next sort of segment of the cycle, you've got interest rates clearly bottomed, yield curve going normal, consumer expectations rising, industrial productions rising, and so on and so forth. So you've got some markers to help you determine where you are in the cycle. So where are we? Well, Here's a chart of interest rates. The red line is the 10-year US Treasury bond. The blue line is the 10-year gilt. The green line is the 10-year German Bund. And you can see it appears to have bottomed and turned around. There's a definite sort of bottom formation in interest rates. If we look at interest rate futures, we can see that the market expects interest rates to carry on going up. So this chart here, the blue line is British pounds. It's the interest rate that you can lock in the future for a 3-month British pound deposit at a bank. The red line is the equivalent for US dollars, and the green line is what we've got for euros. So this is just telling us that, in, for example, March 2023, if you were expecting to get £1 million, you could lock in a deposit rate of about 1.3% by trading the futures. So this just helps us understand what the market is expecting interest rates to do, and we can see they clearly expect them to go up. The yields curve, which I mentioned already, can be illustrated by the difference between the 10-year yield and the 2-year yield. That's what you've got on the left. You've got the red line, which is 10-year interest rates, and the blue line, which is the 2-year interest rate. And on the right, so you can see the difference between the two of them. What's interesting is that in September 2019, it did actually dip below zero. It inverted, and that is a textbook prediction of a recession coming your way. Nobody really knew about COVID then, so I'm not suggesting, a sort of bond market knew about COVID, but it is interesting that we got that signal in September 2019. So it looks to me as if, the yield curve has recovered from being inverted in 2019, and it's getting steeper. And you can see that on this chart here as well. So this is the yield curve for British pounds. The yellow line is where it was 1 year ago. You can see interest rates were much lower. The green line is where we are now today, and you can see that it's moved up a lot. There's been what we call a parallel shift. It's gone up a lot on one hand, but the yield curve is less than where we were, a week ago and a month ago, which is the blue and the red lines. Consumer expectations, well, it's a bit sort of unclear here. We can clearly see that as we reach the bottom of the COVID dip, consumer expectations were pretty low and miserable. They have recovered recently, but also in the last couple of prints, they've come down as well. So, it looks as if we're having, well, my opinion is we're having a sort of short-term pullback in something that's progressing. Industrial production, again, we had this sort of post-COVID, boom in industrial production as we came out of the recession. But it looks to me, and we've pulled back from this peak, but it looks to me very much as if we are finding stability at levels which are elevated over and above what we were seeing in the sort of normal conditions, if you like, of 2017, 18 and 19. So it looks to me that, we had this sort of peak. We are below the peak, but I think there's more industrial production to come, basically above long-term trend going forward. The other things to take into consideration, the average expansion is 65 months, the average recession is 11 months, and we are 19 months into 65 months, so in theory there should be more to come. So when I stitch it all together, on this sort of slightly textbook description of the economy, the red dotted line illustrates where we are. We've got interest rates sort of bottoms and are rising. The yields curve is normal. Hard to say whether it's sort of flattening off a little bit. Industrial production, I think, is rising. It did peak after the COVID the post-COVID expansion, but I still think it looks encouraging. And consumer expectations, I think, show a long-term trend of moving forward. Now, all this analysis informs us of where we recommend what bonds we think you should buy. You know, we have a choice of going long dated or short dated. We have a choice of going high quality AAA or sub-investment grade. We have a choice of looking at FRNs. These are floating rate notes. They adjust the interest rate they pay with reference to some short-term indicator like base rates, for example, or LIBOR. We can look at index-linked gilts and index-linked tips. There are indeed a few index-linked corporates out there, and we can decide whether we want to go for illiquid or liquid bonds. Illiquid bonds tend to yield a bit more because they're more difficult to sell, they're more risky, and you do get paid a little bit more for taking the risk. So that is the process we go through, and then that leads us into these the choices of appropriate investments. And at this point, I'm going to hand over to Rheanna.
Thank you, John. So my main takeaway from that is just how dynamic the fixed income market is. And it's not clear in John's presentation, but the fixed income market is also massive. Monetarily, the estimates in the US are that the stock market's about $20 trillion, the bond market's about $40 trillion. So we can say across the board that fixed income is about twice the size of the stock market. And as John touched on, it can be split into many subcategories, many subcategories. You can, in the last slide, you've got your long-dated, short-dated, you can have long-dated FRNs, you can have short-dated fixed coupons. The combinations are fairly endless. So how do we as investors and as private client investors grapple with such a vast market? And why are funds often considered the preferred choice? Both Hugo and Ollie touched on our preference for direct equity. It's a sort of opposite preference in the fixed income market, and I'm going to talk about why that is. So firstly, fixed income requires a large minimum investment, and that's typically about £100,000 nominal for a single bond. I really want to emphasize that's for a single bond. Corporate bond, gilts you can get for a smaller ticket size, and we do gilts directly, but for corporate bonds, 100,000 nominal for one bond. And if we think about the typical issuers that we like for fixed income especially, your sovereigns, governments, large cap multinationals, when they issue debt, they're typically looking to raise hundreds of millions to billions of pounds in capital. And as such, bonds are, that's why the ticket for a single bond is so high. So such high a minimum investment can make it pretty unaffordable for private investors. And if £100,000 for a single bond is affordable, it would be extremely expensive to maintain the necessary diversification needed to reduce your idiosyncratic risk. So the risks you take on when you only hold one company or one bond. If, as an investor, you only want to allocate £100,000, again, just one bond. So diversification, as we know, is probably the most significant factor in safeguarding your investments long term. So what do we consider diversified? I know that would vary across the board, but I think we can all agree 10 or more. So if you want 10 or more direct single bonds, that's £1 million just there on your fixed income. And for most investors, that's too large of a portion of their investments that they want to dedicate to fixed income. Additionally, as the minimum investment ticket is so high, a very small contingency of large banks or sovereign wealth funds or large fixed income funds get invited to participate in primary issuance. And this can be limiting, especially in a year like the last couple of years that we've had, because the primary market tends to get better value. Essentially what happens in the primary market is you're being incentivized to buy, so you can tend to buy a bond at a discount. Meanwhile, in the secondary market, bonds can be pretty expensive at the moment, and that's a result of interest rates. So for an investment manager of our size, we're not able to participate in the primary market. So investing in a larger dedicated fixed income fund not only has the scale to participate in the primary market, but also the long-standing relationships with those multinational corporates, and this can be a very big advantage. Another factor for the fixed income market that differs from equity is its high turnover. So fixed income has a fixed life. bonds can come into the market and leave the market in pretty short cycles. So you have this constant churn, not only in the market, but also within your portfolio. So let's use that previous example. You decided to completely ignore diversification and you bought your one single bond with your £100,000. And you bought that bond at issuance and it's got 10 years to maturity. And you specifically want long-dated exposure. In 2 to 3 years' time, that bond's no longer a 10-year bond, it's now a 8 to 7-year bond. So you've now got to sell that bond and buy another bond to maintain your stated investment objective of having long-dated exposure. And this is a very specific example, but it's indicative of the constant ebb and flow that you get in the fixed income market. You have to constantly be trading to maintain your specific investment objective, if you have one. I would say most people just want exposure to the fixed income market, but if you have one, you have to be constantly churning and actively trading. Additionally, as John so clearly walked us through earlier, fixed income investing is highly influenced by the macro backdrop. If anything, the last couple of years it shows this quite clearly. The macro environment can change much faster than we expected, and so your fixed income investment has to be as agile and flexible as the market to keep up. So that briefly covers why we use funds, the large investment required, and also the granular analysis needed to execute your investment objectives. So now I'll briefly discuss which funds we like to use, and this is the question I spend most of my time thinking about. The fixed income fund universe is almost as broad as the fixed income universe itself, and lots of the funds are not appropriate for us and our purposes. So I would generally bucket the bond fund universe into two buckets. So your flexible funds and your more specific funds. So if you see the word strategic or dynamic or unconstrained in a fund name, those are your flexible funds. And the specific funds, you can play a nice game of how long can you make a name. So it would be an ethical, short-dated corporate credit fund or something. You can just add extra names to it, and that's a specific fund. So which would you invest in, or why would you invest in one versus the other? So a flexible fixed income fund, the idea behind these is essentially the fund's main mandate is return or a yield target. So the fund will therefore take whatever approach it deems appropriate at the time to achieve the return you require. In reality, it's not so broad. They can't do absolutely anything. It has constraints, specifically around sort of high yield exposure or emerging market exposure. You can get fully unconstrained ones, but typically they have limits around those two exposures specifically. But the idea is it can invest globally and in all the subcategories or sub-subcategories you can think of to get the most value and yield at a time. As such, year on year, you might find yourself holding quite a different looking fund. But the flexibility is really the selling point here. The fund should be able to adapt quickly and efficiently. For the more specific funds, the constraints are baked in. If it's an ethical, short-dated corporate bond fund, it will only invest in ethical, short-dated corporate bond funds. And the difficulty with these is the due diligence tends to be a bit broader. That's because you've got to assess your asset class as well as your fund. The benefit of these, though, is as an investor, you can pick and choose which exposures you want to be exposed to. However, theoretically, you also have to appreciate that that fund cannot shine whatever the weather. It won't be able to adapt to the changing macro environment. So let's say you have a short-dated fund, you decided to have a short-dated fund, and we're in a falling interest rate environment. Versus the short-dated benchmark, that fund can still outperform, but versus the rest of your portfolio, it's not going to shine. Unlike your flexible bond fund, you would expect that that would be able to adapt. And you would get your yield target no matter what the macro environment. So this takes me quite nicely onto the next important aspect, and that is the management team of these funds. And this is where we spend a lot of our assessment time. So our goal is to seek out fixed income portfolio managers who demonstrate expertise and good execution. So that means they actually express their investment objective within the holdings of the fund, or they do what they say they're going to do. And also we want to make sure that the portfolio managers are part of an asset management house that has the resources to sufficiently cover the fixed income market and whatever their specific mandate is. The next couple of slides are illustrative of some of the questions we ask ourselves and we ask the investment managers or the portfolio managers that we meet with the first time, and we repeat these questions regularly and these assessments regularly. And a large part of this assessment are one-on-one meetings with the managers. And these really allow us to dig into their logic and also sense check that they are doing what they say they're going to do. And for larger holdings, we meet one-on-one at least once a year, and additionally in group meetings. So I hope that makes sense as to why, in terms of equities, we really are our bread and butter is direct equity holdings, but fixed income, we think it's most efficient to go about it in the funds route.